Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update for July 1st, 2019. And the market is currently in Market State 1, which is bullish. It's actually near its all-time high, which was placed back both in April and in October of 2018. And both times it sort of reached this zone. The market has actually pulled back most recently in the month of May. So although it's in Market State 1, which is low risk, the market could be prone to a pullback in the coming weeks. Canterbury Volatility Index measures CVI 61. Low and decreasing CVI is a bullish characteristic. Volatility reached its high back in the month of May during that pullback. When volatility becomes extremely low, which is less than CVI 45, the market can be prone to have one or two outlier days of 1.5% or more. And that's kind of what we saw back in April. The market got extremely low volatility and you saw a market volatility spike. Just for reference, the current 10-day CVI, which is a shorter term volatility, is currently at CVI 45. It has been decreasing for some time now, so we could be prone to see a 1 or 2 day market outlier. In recent updates, we've also discussed that the S&P 500 is one of the stronger market indexes. The S&P has been leading both emerging markets and the EFA. So if we're looking at a chart of those two things, we can see that the S&P for the last 2 years has been ahead of the emerging markets and the EFA. And even back in March of 2018, when the S&P started bouncing back off of a sharp decline in the market, the EFA and the emerging markets were both declining over that time. And this is partially due to the strength of the US dollar. So when comparing the US dollar to other foreign currencies such as the euro, the Swedish krona, the Australian dollar, and the British pound, the US dollar, according to Canterbury's Volatility Weighted Relative Strength Indicator, is ranked number 1. That's a risk-adjusted metric. And so if we're looking at a chart of the dollar compared to these other indexes, we can actually see that when the dollar put in a low in March of 2018, the other currencies were actually at an all-time high. Well, as the dollar started to rally, these other currencies started to fall. And that sort of translates to kind of what we're seeing, where we see the S&P 500 behave really strongly compared to these US markets. And then last sort of thing, I want to make a point about exchange-traded funds and liquidity. So since the invention of exchange-traded funds, we have the ability to invest in virtually every asset class. We can invest in equities, bonds, currencies, commodities, and even inverse funds. And the price for being able to invest in those, the price for those securities being liquid, is that all liquid traded securities will have both bull and bear markets. There's going to be a time that owning the emerging markets and the EFA are going to be more advantageous than owning the S&P 500. There's going to be a time when it's going to be better to own the British pound than the US dollar, and a time when small cap growth is going to be more conservative than treasury bonds. And if we do not use that liquidity to our advantage, so in other words, we just buy and hold, that liquidity becomes a disadvantage because markets assume that we know the difference between bull and bear markets. They assume that we can identify low-risk environments as well as high-risk environments. And that is sort of why a buy and hold market philosophy really hasn't worked over time. And that's kind of why we need an adaptive market strategy like the Canterbury Portfolio Thermostat. Thank you and have a great week.